Hello, everyone. Good morning or good afternoon, depending on where you are. I am Rose. Welcome to today's webinar on non-warrantable condo loans. Now, as you questions come up throughout the webinar, we want this to be as interactive as possible. So go ahead and use the little questions function, and we'll ask the questions and interact with you throughout the webinar. And we'll also have a Q&A session at the end. So with that, I'm going to turn it over to today's speakers. Take it away, Janice.
Hello, welcome everybody. I'm Janice. I'm an account executive at Lendsure Mortgage, and I'm happy to be here to teach you more about non-warrantable condos.
Okay, Tanner?
Yeah, and I'm Tanner Williams. Glad you guys are taking the time today. I think it's going to be really valuable for you. I'm also an account executive here at Lendsure, and we'll be teaching about condo hotels.
So, we're going to be going over quite a few things. Like Rose said, make it interactive. We're kind of going over what non-QM is and, addressing the real problem, which is, Fannie Freddie condo restrictions. So we have a solution with our non-warrantable program, and we'll talk about the alternatives for you. And my favorite, we're going to go over some case studies. So like Tanner and I both have scenarios of non-warrantable condos we just recently funded. So those should be fun, and we're going to go over that.
Okay.
So a little bit about what non-QM is, kind of how this fits into your daily life and your pipeline. So it stands for non-qualified mortgages, anything outside of the realm of Fannie Freddie government type stuff, right? We're talking really credit worthy borrowers, really strong borrowers. A lot of people kind of confuse non-QM with subprime. And it's not necessarily the case. So, we're not talking about like FICO's down in the 500s and really bad scenarios. We're talking about borrowers that are great and just barely on the fringes of qualifying conforming. In some cases, they can qualify conforming and they choose to go non-QM. So that's a kind of recent phenomenon that we've seen. But we do a lot of business with self-employed borrowers through our bank statement loans, business owners, that want to keep things simple when they buy an investment, do DSCR. We do a lot with foreign nationals or other, non-permanent resident aliens, those types of things. Condos and condo hotels, which we'll talk about today. That's primarily our focus today. And then, borrowers that just have a unique situation, whatever it may be, multiple streams of income, or, just something that knocks them out of Fannie Freddie viability, but really it's a strong scenario and a strong borrower. So I want to talk for a second about the expanding condo market. The fact that you're going to see more and more condos as time goes on. Nationally, it's estimated 175,000 condo associations oversee millions of individual condo units. So, as land continues to be more and more expensive and at a premium, and as builders try to be more and more cost effective and slam as many units into as small an area as possible, we're going to see more townhomes and more condos being built.
That's right. I mean, with home prices, going up and up and up, condos are really an alternative for first-time home buyers. A lot of prices are out of reach for many buyers today. So really having a great product for condos is going to be amazing to have at your side. And so I'm glad you're all here to learn about what we can do to help if that condo turns up being non-warrantable, right? We save a lot of deals that way. So this really does present an opportunity not only for you to help your buyers, but also help your realtor partners, which is really important too. So, anyway, so go ahead, Rose, next slide's fine.
So, as Janice mentioned, realtors are facing more and more issues, right, getting deals done for condo borrowers. Now, really, one thing that I like to point out is that non-QM is an amazing springboard into building new relationships. So sometimes I'll hear people say like, oh, well, I don't do much non-QM, or I don't want to do much non-QM because, I want to keep most of my business vanilla. And really, what's interesting is if you do a non-warrantable condo deal and close one for, say, a new realtor, and they really liked your process, they really liked how you communicated and just working with you, they may bring you your next 3, 4, 5 conforming vanilla deals, right? So it's a path to get those relationships and those vanilla deals going. Utilizing non-QM is kind of the foot in the door, so to speak.
So true. And well, like Tanner was saying, but sometimes it can derail. It could have been a very vanilla loan, right? You could have been a cookie cutter loan, but you have to have an outlet for it. What happens if for some reason that questionnaire comes in and it turns out you didn't know, but that condo turns out to be non-warrantable now. So
yeah.
So anyway, those are real life issues that realtors are facing today. So it's becoming more and more difficult. It also makes the process much longer and strenuous. I saved a fallout, which I'll talk about later, in very little time, instead of, dragging out the process 60 to 90 days to, do this, conventionally so we can close faster. And it affects all sorts of things. So I'm sure you're aware, and if you've been in that situation where you had a condo turned out to be non-warrantable and you had to get more supporting documentation and more things addressed, and it just became painful, and nobody's happy with a painful loan, right? So this is—
And things change. So it may have been warrantable 30 days ago and you closed in this project, and so you think, oh yeah, no, we're good to go, I've closed here before, right? And then all of a sudden you find out that all the owner-occ people have been selling to investors, and now the investor concentration is too high, and you're midstream and you told this borrower we'd be good to go, and now you got to find another option for them.
so true. Yeah.
So our non-warrantable condo program, the solution here. So this is, as I mentioned, not Fannie Freddie, right? Not government. It's we sell to the third-party market, usually Wall Street investors. So we're able to do things that are more unique, right? Obviously outside of Fannie Freddie guidelines, because we're not selling to them. So we have our own guidelines that we follow. They're going to be pretty similar across the non-QM space, but we do have a lot of flexibility with our loans because of our partner, our primary investor. We actually grant exceptions on a pretty large majority of our loans. So we're able to look at these kind of on a case-by-case basis, right? Look at them as common sense, hey, maybe it doesn't exactly meet guideline X, Y, or Z, but overall we have a fantastic loan here, and we're gonna get it done. So a lot of these non-warrantables boil down to what's the overall risk of the loan, what's the scenario look like. It's not really guideline driven, it's kind of common sense and case-by-case driven.
So I'm going to go over a little bit of what makes a condo non-warrantable. I mean, a lot of you might know it has come up probably in the past. We really look at every type of condo, which means, things like litigation, the occupancy, like Tanner was mentioning, over 50% being non-owner, or a single entity owns greater than 10% of the units. Or for example, some condos don't have all the reserve requirements that conforming lenders need. So a lot of these things will make your condo non-warrantable. And it could be, like Tanner mentioned, last minute. It was warrantable yesterday and now it's not, and now you need an alternative, right? So these are all little things that could blow up a deal. And we really do look at every type of condo. Of course, it is case by case. So it's really important you contact your account executive, and knowing what the issue is going to be very valuable, because we'll address it up front, right? It could be something like litigation and you're really confused if this is going to work or not. Well, let's find out why there's litigation and see if, we're on board. The more you know and share with us, the better situated we are to even make an exception off of our own guidelines.
One of my favorite things about these loans is that depending on the reason for non-warrantability, it actually could be future business for you. So you look at like litigation, eventually that's going to get resolved, right? You look at project not 100% complete, eventually it's going to get completed, right? So if you get borrowers into these non-warrantable, condo loans with us, you're really looking at getting refi business, 6 months, 12 months, a year, 2 years down the line, into refining them into a Fannie Freddie loan, right? Now that condo is warrantable, they're qualifying for much lower rates, and it's very easy follow-up future business for you.
That's a good point.
Jody wants to know, what if it's due to deferred maintenance matters?
That's a great question. It would probably depend on how deferred the maintenance is. If the appraisal comes in subject to versus, as is, it would be a case by case, Jody, but definitely something you should send up to your AE and they can check on that.
Okay, and Anne, yes, I'm going to be sending out a copy of the slide deck along with a bunch of great materials for you guys. Look for an email from me, Rose Waldy, about an hour or so after the webinar, and that's going to have links to the slide deck, and it's going to have links to your private label resources and other great materials. And Holly wants to know, are there prepays on these? Because what would limit refinancing?
Good question. So anything that's owner occupied, primary or second home won't have a prepay on it. Anything that's an investment will. It comes standard at 3 years, but you can always buy it down to 2 years or to 1, and then in some cases even buy it out entirely. There's still an EPO to observe though if you do that. So a couple of different things that we have to be looking at. But we can definitely work with you, structure the deal based on your borrower's goals and what they think they want to do in the future.
Okay, great. And Janice, did we go over this? I thought we already went over.
Yes, we just did.
Okay, so program options. And by the way, before we get into these, Raul wants to know, would this include high-rise properties?
Yes.
Yes, quite a few high rises. I work with high rises a lot. My primary book of business is in Las Vegas. So a lot of high rises there, a lot of high rises in Florida, other places. So yeah, we do high rises quite a bit.
Okay, great. And Fannie Freddie allows land leases. What would make a land lease non-warrantable? Jan wants to know.
Tina, I haven't run into a land lease in a long time.
Depends on the terms on the lease.
Yeah.
So there's certain things, even if there is a land lease and it is allowed by Fannie Freddie, there's requirements on the terms of that lease and what it looks like, when it's up, if it's being renegotiated, all those kinds of things. So you may have closed them in the past with land leases with Fannie Freddie. That doesn't mean every single one that's on a land lease can be closed with Fannie Freddie.
And Darren wants to do, are we doing much business in South Florida, specifically Miami Beach and Dade County? We have a huge team of account executives that focus specifically on Florida. And in fact, they're at FAMP today, the Florida Association of Mortgage Professionals. If you happen to be in the Orlando area, please feel free to stop by and talk to one of our account executives that's working our booth. And Tanner, you want to take us through some program options?
Yes, ma'am. All right, moving on. So some different things that we can do on non-warrantable condos. So non-warrantable condo is obviously the property type, but there's a lot of different options we can kind of pair with that, right? And mostly regarding income. So we can do our 12 or 24-month bank statement program. We can do full doc, both 1 and 2 years, 1099 only full doc, 1 and 2 years. So, looking at the 1099s, but not the tax returns. We have asset depletion and qualifier, which is a no income doc program technically that uses assets as income, or even assets in supplement to income. So I see a lot of people that have a W-2 or have a self-employed job, but their DTI is an issue, and so we use asset depletion as supplemental income, additional income to get their DTI to a place where it works. We'll do investor cash flow, so DSCR, debt service coverage ratio, which is another no income doc loan, specifically for investments that just looks at the cash flow of the property, based on how much it rents for. Foreign nationals, so borrowers that live and work in a foreign country, that want to buy an investment or a second home in the US. We actually allow second homes on our foreign national program, which is pretty unique to us. And then merged income types, which I know Janice has dealt with some in the past, as well as the jumbos, so I'll let her speak to those.
Oh yeah, I love merged income types, and you kind of touched upon it with the asset depletion, asset qualifier. So really, you have to think about something. It's as simple as your borrower can qualify for more loan if they could be W-2 and pay stubs, and their income's fine, but they're not qualifying quite, for what they want, and they also have a 401k with $300,000 in it. We can combine that asset depletion and W-2 and pay stubs, increase their monthly income, and now they qualify for more loan. And what's really kind of cool is Lendsure Condo Program options, which is what we're going over. It's not limited to your Fannie Freddie full doc, a paper. All of these income types would apply to all the types of loans we do, right? So you have a combination of a non-warrantable condo with a bank statement borrower, for example. But we do, or a jumbo loan, right? We go up to 3 million on our standard program. So it really makes for a perfect combo to find a solution. It's not just, oh, it's non-warrantable. It could be non-warrantable and we need supplement income with assets or with 1099 only. So it's pretty cool stuff.
Cheryl wants to know about the single entity concentration. She says Fannie goes up to 25%. Can we go beyond that?
Yes.
Yeah, again, it's one of those that falls into the case by case bucket, right? One of the big questions is how big is the project? So if we're talking like 50% single entity ownership on a project with 10 units, that's far less concerning than 50% single entity ownership on a project with 100 units, right? It really comes down to if that borrower, whoever that is, gets in trouble, right? Has to file for bankruptcy, whatever it may be. That severely puts the HOA at risk, and the HOA being at risk puts our borrower at risk. So that's the risk associated with that. So really just comes down to the financials of the HOA. If they have really strong reserves, the budget looks good, all that kind of stuff. That really helps us to know that they're in a great financial position. If our borrower is the borrower that has the single high entity ownership, that helps too, because we're looking at their financials, right? Hopefully not doing a DSCR loan in that case, right? We're actually looking at their business income and all that kind of stuff. So a lot of different things go into it. It's very case by case.
Yeah.
Okay.
But it can be done, right?
Well, what about commercial space? She says over 35%. What would happen there?
So you like a mixed, I'm guessing like a mixed condo and hair salon type of thing. We do consider, honestly, it's sending the project, sending the address for consideration is going to be your best bet to find out if we'll consider it. So
technically maximum in the guidelines is 50% commercial, but it's one of those things that we have gone above and beyond in the past with good compensating factors, right?
Yeah, and I see a bunch of questions here that are very, very specific. So I want you guys to have as complete and accurate information as possible. So if I see something that's real specific, I'm going to have an account executive reach out to you. I'm making a note of the questions. I'll have an AE reach out to you personally to take a look at your scenario so that we give you as accurate information as possible.
All right, well, moving on to expanded condo options. I really love this option, which is our short-term rental property. So basically, right now, especially, right, with rates being higher than they were before, it does become a little harder, for example, to have your condo DSCR, right? The ratios aren't coming in very high. But a lot of these can be short-term rental properties, and that's what the borrower is buying them for, right? So instead of using long-term rents, we will, offer specifically to finance it using short-term rentals. So that means they're going to look at Airbnb, VBRO, et cetera, right? To find that DSCR ratio to work. And I love it because we go all the way up to 75 LTV on those. So it's a great one to use to kind of fall back on. And I highly recommend taking a look at it. The things to look out for though is if that condo won't allow short-term rents, right? Then we would have an issue with using short-term rents to qualify if they're not allowed to do that. But these things really do help your ratios significantly when needed. So I recommend it.
Yeah, I know personally in the last couple months, I've switched a lot of my DSCR loans to short-term rents, qualifying using short-term rents kind of midstream, right? Because we get a 1007 back from an appraiser and it's not looking good, right? They say, oh yeah, this thing can rent out for way below what the agents think, right? So we switched to short-term rents and we're able to still get it closed. Another option is our cannabis-related income. So I know this is an option for you guys for wage earners. We do it for wage earners as well as self-employed borrowers. The main caveat there is just making sure it's legal in whatever form it's being sold. So I know in Utah, right, it's only medicinally legal, so we'd only be able to do a medicinal clinic that's licensed and all that kind of stuff, right? In like Nevada, California, and other places where it's recreationally legal, then we would be able to do it for both, right? We just need to kind of document that licensing and make sure that everything's above board.
Sheila wants to know if borrowers can be an LLC.
Yes, absolutely. We close on an LLC all the time.
Okay, and Sheila says she's got a comment for Tanner. Great job, Tanner, on our Airbnb just closed.
Yeah, thank you, Sheila. Yeah, we just closed one last month in Nevada. It was using short-term rents, and it was a solid deal. It was a good deal.
Okay, fantastic. So it's one. Mm-hmm.
And speaking of helping qualify, there's also our interest-only product, which can also help your ratio be better. It also is great for investors who are looking for lower monthly payments and to maximize their cash flow. So we do have an amazing IO product. So, and we can apply that to our DSCR and across the board. And we will use the IO payment to qualify. So that does help the ratios. And there are also, I'm seeing the slide also talks about our ability to finance points and broker compensation. I believe we're going to talk about that a little bit later on, but you have to understand that that's amazing. And it's on a purchase. You can actually add points to the loan amount instead of having the borrower bring that out of pocket. It brings cash to close, you know, a little bit lower for the borrower, so that's always great. And IO product is eligible for all doc types, so it could be a bank statement loan, asset depletion, DSCR. We can go IO, and it's 10 years of interest only, and it rolls into a 30-year fix, so that's a 40-year term. And
Yep.
No surprises down the line, right, Tanner? The
Correct.
rate's
Yeah.
not going to balloon later in life. It's going to stay the same.
Exactly. Fixed rate the whole time. And I love this last bullet here talking about the jumbos again, because when you look at IO, we actually have a high DTI program specifically built around this product. And how that works is we'll allow the DTI to go up to 55% if the IO DTI remains under 45. So the most likely place you're going to see that is in the jumbo realm, because when you look at IO versus not on like a $150,000 loan, it's like 75 bucks, right? It's not
Yeah.
crazy. When you look at the IO versus the fully amortized on a $3 million loan, you're talking like several grand, right? And that's obviously a large swing in your DTI calculations. And especially right now with rates as high as they are, qualifying for jumbos is harder than ever. So the interest only, keeping that payment low, and qualifying on that interest only payment is huge for getting those borrowers into those large purchase prices.
So true. Oh, remember I said this is my favorite. I love talking about scenarios that we closed, and this closed last month for me. So I had, you know, I'll go over, and this is just to also kind of understand our thought process and what happened, right? So you can, you know, say, hey, you know, to your account executive, I have this condo, right? This was, you know, a call I had with the loan officer. I have this condo. It's, you know, it's worth $5 million and nobody's financing it because there's active open litigation. And, you know, the borrower was solid. He had a lot of reserves and the LTV was low. So it's definitely something we wanted to take into consideration. So the first thing I did was I got a lot of information on what is the litigation? What is the problem? This had to do with the facade. The HOA was suing the builder because there were some issues with the outside of the building. It didn't cause a health or a safety hazard to anybody. So it was definitely something we wanted to take a look at. And it ended up being a $2 million loan. Another exception on this was our cash out to $800,000. Sorry, not 800,000. Yeah, 800,000 it was. We paid off this existing lien. The borrower had to get a hard money loan to purchase the condo because he couldn't find financing, right? And later down the line, he found a loan officer who was able to help him. And this also used short-term rents. So think about that. I had condo with litigation. I was above our cash out max, and I qualified using short-term rents, and we funded it, right? So it was 40 LTV. One of the things that did go on here in order to get the exceptions granted was we did ask for an additional 12 months of reserves. And that was really meant to cover the time the property wouldn't be rented out while they repaired the facade, right? So there was going to be a time where that property was not going to be able to be rented out to short-term rental, or to anybody. And that was all our solution, right? So we're really common sense lenders. Like, well, if we can make that work, then why not? And that's kind of why we say it's always case by case. So that was a real favorite one of mine.
We've got a couple of different questions on, on litigations, and what's a litigation that would be like a deal breaker that we won't do that?
Yeah, great question. One that really comes to mind is health and safety issues. Would be most likely a deal breaker for us. Again, they're so case by case, and what's exciting about the loan industry, right, is there's always something different, right? Something new comes up, and so it's very hard for us to really know exactly what 100% would be deal killer, but that's something that is on the top of my mind that our underwriter expressed to us is, health
and safety issues usually boils down to structural litigation, right? If we're calling into question the structural integrity of the building, we're probably not going to lend.
All right, another one of mine that funded last month was a fallout. And I mentioned this before, but we closed it in 14 days. So we basically got a full package. It was an owner occupied for a paper borrower. And very last minute that, HOA cert came back to the loan officer, and it turned out to be non-warrantable. And, so we took everything. I got all the information. The very first thing I said is, why is it non-warrantable? Give me more information on that specific topic. The borrower was super A paper, 2 years full doc, DTI was 36, 810 FICO. You don't see that every day, right? So the one elephant in the room was, why is this, condo non-warrantable? And it came down to, one thing, they had a mandatory clubhouse membership, and that made it fall out, right? So we were okay with the deed restriction on this HOA, and we moved forward, and we closed in 14 days. And loan officer was very, very happy, and we really helped him out. His borrower was also very grateful, and it was a very smooth process. It was just really finding out the why, and that's what I always recommend. If you know something's going to be non-warrantable, get the details, because then we'll know for sure if we're able to do it, especially if it's outside our normal non-warrantable condo guidelines.
Sandy says, I had an agent tell me her listing on the condo doesn't carry enough insurance. How would that work? Does the buyer have to obtain additional?
Depends on the situation. So there, insurance for what, right? For flood, is it the master insurance policy from the HOA, right? So I know in California right now, there's a lot of issues with like fire insurance, and a lot of premiums being raised, and therefore HOAs are deciding to, only cover a certain percentage of their project rather than the whole project. So I know we've approved stuff like that. It really comes down to, the comfortability with the loan that senior management can get to. So for example, if I have like a project with 500 units and the policy covers 50% of them, that's 250. Is a fire really going to wipe out all 500, or is it going to wipe out some of them before the fire department shows up and puts it out, right? So we are exposed there, right? If all of the units go up in flames, but from a risk perspective, if we're able to get comfortable with it at a low enough LTV, it's something that we could definitely look at.
Yeah, I would definitely take that scenario to your account executive so that they can check on it, because they are case by case.
And I've got a couple of questions on how to they get approved to do business with us. Go ahead and reply to the email that you're going to get from me about an hour afterwards. Reply to that, and I will get you started.
Cool deal. So now my turn to talk about one of my scenarios. So this was a non-warrantable condo that our competing lenders were being forced to call a condo hotel. So it's a development up in Park City, Utah. Really the biggest thing is there was a front desk, and there was verbiage in the CC&Rs revolving around nightly, weekly rentals. So they were saying, oh, this is definitely, you know, a condo hotel, there's a check-in desk and all that kind of stuff. But after we really dug into it, we were able to realize that there's no rental pool. So for us, whether something is a condo hotel or non-warrantable really revolves around the existence of a rental pool. The front desk was there, you know, as sort of like a concierge and towel service and different things for the owners of that, you know, of those individual units. But it wasn't like I could walk in and book a room for the night, you know, utilizing the rental pool that the HOA manages, right? Like you would typically see at a hotel. So we were able to call this non-warrantable condo. You know, as with Janice's, we had a couple competing things going on here. It was obviously in the jumbo realm. And we were actually even able to utilize that stacking, that financing concept that Janice talked about, and we'll talk about more, to take our LTV up from 70%, close to 72%. And we still priced it as if it was a 70 LTV loan, right? We didn't price it up in the 75 tier. But we were able to reduce the cash to close, you know, significantly on such a large loan size by taking a lot of the closing costs and financing it into the loan amount itself, making it much more attractive structuring of the deal for this borrower. So this one was one that I was really excited to get closed, and you know, it leads to future business in that same project where we can say, hey, you know, we're not hitting that with condo hotel pricing. We're looking at that as a non-warrantable. All right, condo hotels. So perfect segue. Condo hotels are going to be operated essentially as hotels, right? Usually in resort areas. So when you think of second home destinations, right, you can think of condo hotels. So a lot of them in Florida, that's kind of where they started more or less. But we're seeing more in urban centers, you know, Chicago, New York, Las Vegas, and we're also seeing them really in any second home destinations like lakes, ski resorts, right, things of that sort. So they're popping up more and more. They're becoming more and more common. I'm hearing of condo hotels, you know, downtown LA, places like that, where I really didn't expect to see them. So, you know, if you run into these, you definitely want to know, you know, what you're talking about and how you can potentially get those borrowers closed.
All right, so now that you know all about condo hotels, we can tell you a little bit about their guidelines. We do go up to 75 LTV on purchases and 70% on rate and term refis. And even for those borrowers that have owned a condo hotel for a while, we can go 65 LTV cash out. And we do have our DSCR condo hotel program to 70 LTV. So a lot of different options, and I think condo hotels are pretty amazing. I mean, who doesn't like kind of a hotel lifestyle, right? And they can make money, also vacation there. And there's, you know, there's a lot of things that are pretty cool about condo hotels. Renter concentrations, okay, up to 100%. So, you know, that's pretty unique from other condo guidelines. Right? Because it's meant to be rented out. Anyway, we do need a minimum of 600 square feet. However, I know Tanner's closed some that have been smaller, and I think I did one too. So if it is smaller than 600 square feet, you would want to ask for an exception and they'll consider it. Something's important to know, it should have a livable kitchen. So not just like a little mini fridge. If it looks more like a hotel room than a condo, you might not be able to get financing for it. So I know there's one up like Hard Rock that's just a hotel room with a mini fridge, and that's not something we can do. And it's smaller, way smaller than 600 square feet. But these are our simple guidelines to condo hotel program. And honestly, a lot of people don't know they can get financing for these projects. So it's really cool to say, hey, you know what? I can be your go-to LO for condo hotels. That's one way to just go get clients. Go to condo hotels and be like, hey, I have financing for condo hotels.
Yeah, Janice, you completely read my mind there, because one of the things that I love talking about with condo hotels and foreign nationals, those are the two that this really applies to, is more than any other type of borrower, any other type of property, foreign nationals and condo hotels are owned free and clear. So because foreign national borrowers and condo hotel owners don't know that financing exists for these types of situations. So it's a great way to generate new business, low-hanging fruit, right? Go find somebody that owns or bought some of these recently, you know, in cash, and say, hey, we have delayed financing. We can get you some cash out if we close fast enough, and price it as a purchase, right? Treat it as a purchase. And even if not, even if you bought it a year or two ago or whatever it is, we can still get you cash out so you go buy another one or two more, right? And cash flow on those just as heavily as you were cash flowing on the first one.
Yeah, and I seem to see that borrowers who buy one condo hotel don't stop at one, right? So it's an investor business too, right? They're making good cash flow, they're happy, they're going to want another one. And if you're able to help them get financing, well, they have more money available for another down payment for a second or a third. So, yep, gotta love repeat business.
All right, my second scenario. So this one was very, very interesting. I'm still shocked we got it closed with the level of risk on the loan. So many competing factors. So this was a DSCR purchase. It was a 475 square foot condo hotel, so below our 600 guideline limit, for a first-time home buyer. So this was another Park City development. It was recently completed about a year and a half ago. Now, normally on our DSCR program and most other DSCR programs, we don't allow first-time home buyers, right? And the primary reason for that is occupancy concerns. If I live in a one-bedroom, one-bath apartment and I'm buying a three-bedroom, two-bath house a block away, I'm probably going to be going and living in that, right? It's very hard to make the story make sense where you're not. Now, in this case, the borrower rented and worked at a physical location in California, and Park City being in Utah, we were able to pretty confidently put together the story that they weren't going to be moving into the subject, especially with it being 475 square feet, where the house they were renting was a pretty big, pretty nice house. So we were like, all right, occupancy concerns we got past. So now it's all about the square footage. So, being under 600 square feet, as we mentioned, the biggest thing is the livable kitchen. So this one had not a full-size fridge, but it had a slim fridge, right? Not a mini fridge. It had a stovetop burner built right into the countertop, had a dishwasher actually, it had a sink. And then as far as the style of it, it wasn't like all one big room that had, the kitchen like right next to the bed, right? It had like a kind of living room kitchen area and then a doorway into like a separate bedroom area, which more resembles a condo than it does a hotel. So for all those reasons, we were able to get this done. We did the same thing with stacking, right? We took it up to a 67 LTV, even though we really only qualified and priced off of 65. And then, borrower had good FICO and good assets. So those were the two main things that served as our compensating factors to say, hey, look, I know we're a little bit shaky on our collateral here on our property with the small square footage. And we're a little bit shaky on our income here and that we're just relying on rents. But the good news is the borrower's got a great track record on their FICO and they have tons and tons of reserves. If they ever get in trouble, they're able to pull from that and still make the payments. So this one was a really fun one, closed last month, and I'm hoping to do some more.
Okay, great. And then Anne wants to know, for foreign national condo hotels, do we need a US FICO score?
No, you don't. For national loans, we'll accept foreign credit reports. A lot of countries now are issuing credit reports or alternative trade line letters, and we just ask for 3. So you don't require anything really American because they're supposedly living and working in a foreign country. So you'll be okay with foreign credit or alt trade line letters.
I'd also like to plug the fact that Janice and I actually were the speakers on the Foreign National webinar that we did a couple months back, and you can find that on our website, or if you reach out to your account executive or Rose, they can also point you in the right direction on that. But that webinar was a great one where we went fully in depth on foreign nationals and what that program looks like and what we do for those borrowers.
Absolutely. Yeah, if you go to our website under broker resources, you'll see a link that says mortgage professional webinars. There's our entire library of mortgage webinars that you can view and you can share with your support staff so that they can better understand these programs.
Very true. And also very important, if you do watch a webinar, still check your guidelines with your account executive. Things get better, things get worse, things change, right? So definitely check those guidelines with your AE just to make sure that you're still in that LTV range. One of the guidelines that I love that we recently updated was that short-term rental guideline. So, I'm loving that. So anyway, so now that you've heard us and you're excited and you want to close more loans, what do? You contact your account executive. If you don't have one or don't know who it is, contact Rose, and she will make sure that you're connected with one of us. And then you're going to submit your loan for pre-approval. We do a full pre-underwrite, and honestly, I think that makes us really valuable because it's really knowing upfront if your loan works versus waiting like till later. So I love our pre-approval process. We ask for, you know, an application, income if it's not a DSCR, assets, and you know, credit report, all those things, and we take a look at it, put it together. If there's questions, if for example, you say, hey, it's non-warrantable, first thing they're going to ask you is why, right? And the more you know, the better able they are to tell you, hey, we're on board, or you know what, that's an exception, we're going to have to go to upper management, right? So you get us all this stuff, send it over, and you'll get a pre-approval. And with pricing, you discuss that with your account executive. Maybe you want to finance a buy down and your broker comp, right? So I don't, you know, we just look at all that, and usually that takes 1 to 2 days. It depends on the complexity of the loan. Sometimes you don't have all that information, and having our team look at it will help us ask those questions that now you can go back and ask the condo for that information, or the borrower. And it's pretty simple. That's how you submit your deal.
One thing I want to highlight on that, because I did mention earlier, we grant a lot of exceptions, right? We call ourselves a common sense lender. We look at things case by case. So that decision on bullet number 4 there, that's a decision rendered by senior management more often than not, especially if there's an exception, right? And that may be our head of credit risk over the East or West Coast. It may be our president. He's actively decisioning loans every single day. And what's really nice is that happens in the first, 48 to 72 hours. And so the underwriter that eventually gets the loan, there is no denying the loan, right? Our president approved it. That's several pay grades higher than the underwriter. So to have that solid decision in the first couple days and know that, yeah, this is good, we're not going to run into any issues. It really helps preserve your relationships with your real estate agents, right? Where you're not, pulling the rug out from under them and looking like the bad guy, right, halfway through the transaction. Our fallout rate is incredibly low, and when you combine that with our industry-leading turn times, I mean, it's a recipe for success.
Oh yeah, yep.
So today's opportunities. So some other things that we can do. Obviously this presentation was mainly on condo tells and non-warrantable condos, but we do want to hit on some other things, some things we've done webinars on in the past that you can find on that page that Rose mentioned, and even things that we haven't done yet that we will do. So these are all things that you can ask your account executive about to get more information, but our bridge program is absolutely phenomenal. I've closed 4 of them in the last 4 months. Beats out the terms on hard money pretty much every time, and very, very unique to us. Really nobody else offers this. So
it's my favorite.
It's a program that you can for sure utilize to your advantage, and great conversation starting with agents, right? Cash out, right? We talked about that with Janice, oftentimes exceeding program maximums. For national, we discussed a little bit, multi-units. Second homes is an important one to hit on because of LLPAs. So oftentimes we're pricing out very similarly or even better than the second home options that you're typically looking at, just because we don't have LLPAs, right? We're able to quote a rate more or less at par, right? You're gonna have your points in borrower paid comp, but we can oftentimes finance those, which was here on the right, Janice will talk about in a sec. And then closing an LLC. We mentioned this too, but I just want to hit on it again because it's really important when you talk about 1031 exchanges. So if you rewind back to about October of last year, I had a borrower that sold an apartment complex, had a couple million in a 1031 exchange. Now that apartment complex was vested in the name of their LLC, which means the LLC owns the 1031 funds. So you can't close a Fannie Freddie loan with those funds, right? So the borrower's option was like, oh, I can buy like 5 single families all cash, maybe cash out refi those and then try to buy some more, and then I got to quit claim everything into my LLC and all this stuff, versus he just sat down and looked at DSCR loans with us, and we did 12, 13, 14 DSCR loans for him, all his purchases, right, all with like 25-30% down, and just kept it really simple and vested in the name of that LLC. So it was something that the borrower really took advantage of.
Okay, and Robin wants to know, is your operations / underwriting on the Pacific Coast, or do you have ops centers on the East Coast? Now, we have a whole team, huge operations center in Georgia. We have one in Rhode Island and one in Utah that Tanner is works out of, in addition to our headquarters in San Diego, which Janice works out of. So you're going to get regional support You're going to get operations people that really understand the market that you are lending in.
Yeah, that's important to understand where you are. Well, why partner with us besides obviously getting to work with me and Tanner, which we love to fund loans, right? There are a lot of other reasons why, but we've talked about the flexibility that we have, working on exceptions with compensating factors. It really does come down to what we love to talk about, which is our common sense underwriting, common sense lending, right? If we can make it make sense, why not? Right, but that's I think one of the top reasons is we can really give you upfront, honest, quick answers that will help you. Even a quick no sometimes, while I don't like saying no, is still very valuable, right? So honesty and great service is one great reason to partner with us, besides our wide menu of amazing loan programs. So we are all trained to structure your files, to understand what the risks are, and really try and see where we can help you close the files. And so that pre-underwrite that I spoke to about earlier, I think is one of the best reasons why you should partner with us. And we have a lot of great inside people that Rose was mentioning all over the States. So our turn times are fast and our answers are solid once we get that upper management signature on your exception loan.
Yep. And to hit on the financing and stacking one more time, because I really do think it's one of the best things that we offer. Also very unique to us, along with the bridge loans, right? The ability to lower your closing costs, your rate, and your payment simultaneously, all three of those things, with the trade-off of a slightly higher loan amount, is something that a borrower is going to jump for every single time, right? I know a lot of borrowers that are rate conscious, or like, what's my monthly payment going to be? What do I got to wire to the title office, right? But if you say, hey, I'm going to give you a slightly higher loan amount and lower both of those things, they're going to spring for that 9 times out of 10. And it really helps when it comes to competitors, right? And you're getting shopped in the non-QM space, right? And XY competitor is quoting an 1/8 better on the rate. It's like, well, they can't finance points. So not only is their cash to close higher, but our rate actually ends up being lower once you finance in some rate buy downs. So there's just no reason that the borrower would go with that other option when it's all said.
Yeah, that's very true. I've had a lot of loan officers win over deals they thought they were going to lose to a competitor because of our financing the points. So I'm glad you touched upon that again, because it's amazing.
All right. And I had several people ask about marketing materials and how to reach out to your realtors, etc. Ta-da! This is a marketing resource kit that I put together for you guys. As you can see, it's got flyers, it's got email templates, and even social media graphics, and how to find these deals. Just let your realtors know that these happen, so that when they come up with it's non-warrantable, they pick up the phone and they call you right away. So just make them aware. So there are email templates, as I said. And the cool thing about these flyers is that the space at the bottom, there's a space where you can click and you can insert your logo, insert your contact info, even insert your disclaimers at the bottom. So they're fully customizable. And it's the same content, just 3 different styles to find one that you like the best for your personal preference. And this one, look for the link to the slide deck, and that's going to be here. But there's also a link. I'm going to send you a link to a non-QM resource kit that has a full range of marketing resources, not just on foreign national and condo hotels like you have here, but on foreign national loans, on fix and flip, on bridge loans, just a ton of different programs, so that you can start marketing these non-QM programs right away. So here's one on non-warrantable.
In regards to marketing, one thing I want to hit on that we really love to do as account executives is we love to do joint presentations for both you and your real estate agents. Yep. So as a reminder, we're wholesale, right? We don't employ any loan officers. We're strictly a broker option, right? We partner with you. So I oftentimes am doing Zoom calls and brunches and lunch and learns and different things where I'm not only speaking to a loan officer in their office, I'm also speaking to every loan officer's top 2 to 3 agents that they invite in, right? Because it's great that you guys are here learning about this stuff, but if you don't get it on the front lines, right, with the agents they don't know that you can do condo tells, so they never give you a phone call, right? That's really where the rubber meets the road in actually building up your pipeline and generating more business. So we want to help you guys as much as possible to get the word out and partner with you and your agents to close these deals with you.
Okay, great. And here's again, there's marketing resources specifically for condo tells as well. When you get the slide deck, you can just see how when I hover over, that's a link. It's going to take you to a Google Drive where you can download that material, and then you can print it out and bring it to open houses, etc. So with Q&A, we've, by the way, before I forget, so as I mentioned, in addition to the slide deck here with these specific resources, when you get the folder with the non-QM resources, it's going to have more than just the private label resources. I included a white paper on there on how to implement non-QM, and so that you can start generating new business right away. We've got our infographics in there and other materials. So take a look at that, and I hope you find that valuable. Guys, I have a ton of questions on down payments / LTVs for condos, condo tells, second home condo tells. Can you guys cover that?
Yeah, absolutely. Well, it's going to depend also on the type of income documentation that's going to be used. So it's a little bit more complicated than just addressing, so for example, if it's a condo tell versus a non-warrantable condo, that could change. But a condo tell purchase, for example, using income as a second home, 75 LTV. Right? If we're doing a DSCR condo tell, believe it's 70, right, Tanner? Off the top of my head,
70. Yeah, 70 non-warrantable, 75 on DSCR. If we have like a super straightforward borrower that's full doc or even bank statements and they're buying it as like a primary or even an investment, we could do 80. That's the highest we go on non-warrantables. Highest we go for condo tells is 75. But again, there's a lot of different things that are going to affect that. We talked about high rises earlier. That's something we typically draw LTV back 5% for. As I mentioned, I do a lot in Vegas. So if you're talking about like a high-rise condo tell in Vegas, like Palms Place, Trump, or MGM, those are even lower because they have other issues, not even including condo tells or high-rise. They have HOA delinquency issues. So it's layers of risk, right? The more layers of risk, the lower the LTV. So on those ones, we're usually like 50 to 55, maybe 60. Single entity ownership, same thing, right? I mean, 26% versus 55%, those LTVs are going to look different, right? So it's just all case by case.
How many Jude wants to know, how many units can you lend at once for a condo tell?
So technically we can go to 10 units for one borrower, like 10 loans for one borrower at one time. Now, I have gone above and beyond that before with exception pricing. Also, it depends on how often we're closing with that borrower. So, for example, if a borrower wants to close like 20 units today, that's different than they want to close like 5 units a month, because we can put those into different securitizations when we sell them on the third-party market. So it's kind of a loaded question. It's technically 10, but we'll go higher.
Yeah, but they're going to want to consider if they're buying in the same exact condo complex. They're going to want that's something I would take to upper management, for example. If they're buying 10 condos in the same complex, they're going to want to look at that. They're going to want to see the risk. How many condos are there in the complex? There's a lot of things that go into that, but it's a great question, and I'm sure we're willing to consider it. But I would definitely have your account executive find out from upper management, know the address of the place. There's a lot of things, but yeah.
Are you going to bump up against the single entity ownership, right? I'm buying 10 and there's 15 in the project. Okay, well.
And he already owns 5. No.
Exactly. That's a problem.
I got a few questions on new construction / ground up construction takeout. Can you guys address that?
Sure. Ground up construction on our fix and flip is not permitted. So if that, I don't know if that was geared towards our fix and flip program that we flashed on the screen, didn't really talk about, but we do construction takeout all the time. So new builds don't scare us. we can finance on those. What else was it, Rose?
Construction takeout, ground up construction, and new construction.
Yeah, so I can speak to the new construction because that's a great question specifically for condo hotels and non-warrantables, especially with the project completion issue, right? So for example, I'll use Pendry in Park City because that's when I closed like 5 loans out of when it was first built a year and a half ago. Whenever we're the first lender into a project, and that doesn't matter if it's a condo hotel or a non-warrantable condo, we're pretty much always going to cut LTVs back just for the risk. We need cash closings so that we have comps in the project. And we want to know what other institutional lenders there are that are financing there, right? Or is it all like builder lender, which is a little bit more risky. So for the condo hotels in Park City at Pendry, we did 65 LTV to start. We were one of the very first ones into the building. And so, for a non-warrantable, maybe we would have been at 70, right? Obviously that was a year and a half ago and the market has completely changed since then. So it's going to be very case by case, depend on senior management. But as far as new construction goes, we typically have LTV cuts. Janice mentioned we won't do ground up construction. We will sometimes do stalled construction. So, I have 80% of the property completed and I ran out of money and now I need a fix and flip loan to finish it off. We'll do some of those case by case. Yeah. But as far as like land loans or ground up construction loans, we don't do those.
Are most, oh, I'm sorry. Go ahead, Janice.
It's okay. I was just saying also with the new construction, sometimes the HOA doesn't have all the reserves yet. So it's something that we have to take a look at, but we still accept it. It is case by case.
Are most new projects considered non-warrantable condos?
They can be if they're going to be built in phases, right? It really depends on what the Fannie Freddie questionnaire looks like and how they fill that out. As Janice mentioned, oftentimes these new projects aren't really funded yet to have HOA reserves, so that can be an issue with new builds. It's not 100% of the time that it's non-warrantable, but oftentimes, yeah.
Have you guys ever run into financed on Indian leased land?
Yes, I have. We won't do that.
Okay. All right. What about new condo project? I think you got that do not meet Fannie pre-sale requirements. I think you guys just touched on that, right?
Say it one more time. Sorry.
Okay. Do you allow new condo projects that do not meet Fannie Freddie pre-sale requirements, 50% sold to one owner occupied?
Yes, we do.
Okay. Ratios for DSCR, what are they?
Depends on what they're the program, what they're trying to do. If it's a, for example, just a regular DSCR loan 1-to-1 is preferred, but not needed. We have a 5-to-8 unit, which requires 1.1. We go to 0.75 with, I believe, a 740 FICO. And at 65 LTV, we can do a no ratio. It does add quite a bit to the rate, but we could, with 35% down and good FICO score, not even count the ratio. So
yeah, and if you're at 1.25, if you're cash flowing very well, you actually get a quarter off the rate. So that's something to consider.
If you're very lucky.
All right,
usually that's like 2 to 4 units will cash flow better than, a condo or a single family.
Yeah.
Brandy, when you get the email from me in about an hour, go ahead and reply to that, and I will assign an account executive to work on that scenario right away. I just don't want to, just reply to that email. I will have that taken care of for you. Can we do bridge loans in Texas?
Investment, right? Only.
The answer is no. The main issue is we can't find a title company that's going to insure the loan the way we need it insured because of Texas state laws regarding homesteads. So if you want to help us and try to explore getting that approved in Texas, reach out to me and we'll talk with your title company and we'll see if we can get something worked out. But we have yet to find a title company that's going to do it the way we need it to be done.
And how do we determine the rents for short-term rentals? Is that the appraiser or Air DNA? Not sure what AirDNA is. Maybe you guys do.
Oh, we do. We know AirDNA. Yeah. Actually, there's both. So depending on the situation, but you could, if you can get the appraiser to do a 1007 with short-term rents, we will use that. We can also use AirDNA report. It has to meet certain guidelines. I believe like a whole year's income. We divide that by 12. If you're above 65 LTV, we'll use 75% of that. Short-term rents. I'm trying to think of other things. I've had one where they own it, they can show proof, they have 12 months proof of their short-term rental income. We'll consider using that. So
that's where I was going to go. Sometimes it's a combination, right? So this one I just closed last month for Sheila, which we mentioned earlier in the presentation, right? So the appraiser sort of kind of filled out the 1007 with short-term rents, but not really. He gave like a range, and the median in the range and the high end of the range we ratioed, but the low end of the range we didn't. And he didn't commit to giving us like one solid number. So then we pulled the AirDNA on it. The AirDNA showed really strong numbers, but didn't quite meet guidelines as far as occupancy. And so then we went to the seller, and the seller gave us 12 months history of their Airbnb and VRBO, and that showed really strong numbers. And we're like, you know what, like technically we don't really meet guidelines in any of our locations, but we have these three things that all really support like strong rents. So we're going to close the loan. So again, it comes back to the common sense piece, right?
For condo sales, what exactly do we mean by a livable kitchen? A stove with 2/4 burners, full-size fridge, a sink. What do we mean?
As livable as we can get. It depends on how much you're putting down and what the square footage is. Have I closed ones in the past with no burners? Yes. Would I prefer that? No. So there's nothing set in stone. There's nothing like you hit this or you don't get the loan, right? It's how much are they willing to put down? What's the square footage? What's our pricing like, right? Maybe we'll do it, but we'll add more to the pricing. There's a lot of different things that go into it, but just it's very subjective. So reach out to your account executive. They'll reach out to senior management. Oftentimes it's the president of the company rendering decisions on that front.
All right, one last question. On full doc loans like W-2 for non-warrantables, how do we compare with Fannie as far as rates?
Higher.
Yeah. Well, remember, Fannie won't do it, right? So our rate will be higher, but we can close the loan, right? We're not a conventional lender. We have our super prime rate sheet. We have buy downs, but yeah, you can't really compare. It's comparing apples to bananas.
and this is what I was telling you about future business, right? The rate's going to be higher, but obviously if it becomes non-warrantable, then you have a great argument to refi them into a Fannie Freddie loan again. The stacking concept and financing in points will really help finance and rate buy down and get us at least a little bit closer to their original expectations, even if it's not all the way. Really, second homes is the only place we're actually competitive with conforming, which is what I mentioned, just because of the LLPAs. But in most cases, even if we're full doc, like for example, our full doc and our bank statement loans only differ by like an eighth at most. So it's pretty similar, regarding the income type. It's all about the property.
Not to mention with that 1040 function where you can really manage the monthly cash flow on that can make such a huge difference.
Actually, one thing I will point out though regarding our full doc is we don't necessarily need tax returns. So I've actually closed a couple full doc loans that are with me for no reason other than I can make it DTI and they couldn't with Fannie Freddie's guidelines. And really the primary place that will show up is in the investment, like the REO schedule, investment properties, and in the credit as far as deferred student loans. So we'll avoid Schedule E's entirely. We'll collect lease agreements and then bank statements proving the lease agreements are being collected. We'll look at short-term rents, obviously, with Airbnb stuff, right? That maybe wasn't claimed on a Schedule E. If you have like letters and different things from servicers on student loans that say they're deferred for 3 years, we can take those completely out of the calculation instead of using 1.5%. So there's a litany of reasons that we may be able to get something to DTI full doc, but the rates will be higher for sure.
All right.
Less than 2 years self-employment's another one, right? I have you know, 1 year of tax returns. I started the business 1 year ago instead of 2 years ago, and so I can't do it Fannie Freddie, but we can, right?
All right, with that, I want to say thank you to everybody who took the time to join us today. Again, if you have any other further questions or if you want to be connected with your account executive, please respond to the email that you're going to get from me in about an hour. Tanner, any parting words?
If you want to look at those Texas bridge loans, reach out to me. I've been trying to make those work for a while.
Dennis?
Just thanks everybody for your time, and please don't hesitate to contact us and your AE, Rose, me, Tanner. We want to help you close more loans, and giving you this opportunity with a wide menu of different products and common sense lending is really a great solution. So we thank you for the partnership and look forward to working with you.
Thank you very much, everyone. Goodbye.